Hey everyone, Daniel Snyder here from Seeking Alpha. Thank you for taking the time to tune into this video. We had to do it because time is of the essence. You obviously are all watching what we're watching here in the markets. The oil volatility is off the charts. We've seen the spikes, we've seen the pullbacks, we see constant updates every day in headline news right now. So we threw together this quick presentation today with Stephen Cress, who him and his team have done the research, and we're going to dive into the research right now, as well as present five stocks for you today that could benefit extremely well in the months and years ahead based off of the Seeking Alpha Quant system. But before we do that, let's go ahead and get this quick legal disclaimer out of the way. We are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, strategy, or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents my opinions and Stephen Cress's opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results. Seeking Alpha is not a licensed security dealer, broker, U.S. investment advisor, or investment bank. And with that out of the
Well
way, I
said.
want to bring in our quant titan. I always call you the titan because the quant system is fortified, right? You are the guy, the master of
Thank
the
you.
house. The people that know of you know that you have a long history within the financial industry, from time at Morgan Stanley and your own hedge fund and working on Press Cap, which eventually Seeking Alpha did purchase and brought you here today. But Steve, thank you so much for all the time that you always give us. Anything you want to mention to kick off before we dive into what's going on within the
Yeah,
oil?
no, first off, I want to thank you for organizing this today and for the viewers who are watching it. It's obviously very timely. And I think there's one thing that I do want to emphasize. We're going to focus on five quant strong buys that are in the energy sector. And I want everybody to know before this crisis occurred, when oil was down at $60 a barrel, these stocks were strong buys. Obviously, with oil going from $60 to 120 and back down to the 80 level, these stocks are still strong buys, and we believe they have great fundamentals for the long term. And that's why we want people to focus on them. We believe they're mispriced. So, despite the crisis, we already believe that these stocks were high quality energy strong buys. So, that is the first and probably foremost thing I really want to get across. Um, what we're going to do today is we're going to provide a quick market snapshot. I'm sure people all over the world are watching the equity markets and the energy markets and looking how it's impacting their stocks and the economy, why we use quant, and the top five energy stocks that we're selecting today. So right now, what are we saying? I love this chart on the right-hand side because it shows you a 1 year change in commodity prices. And you can see silver and gold are topping it, and silver and gold have been fantastic performers. Uh, more or less over the last year, there's been a strong belief that inflation could be sticky. That's one of the key reasons. But another key reason is central banks all over the world have been buying gold for the last several years, and that pace has not stopped. So that's really been pushing it. And a lot of investors have just been nervous about the environment. So whenever we have a rotation to safe haven asset classes, typically silver and gold do fairly well. At this point, though, I will highlight gold and silver actually have come off a little bit as we've gone into this crisis. And my belief is it's because it's had such a strong run up over the course of the year that there is profit taking in these commodities. But typically, when investors are nervous about inflation or there's fears of a recession or a poor economy, people do tend to focus on this asset class. And of course, with the current geopolitical events and the Iran conflict, fuel prices, oil prices, gas prices have all surged. I'm not sure it was today, but obviously over the weekend, we saw fuel surge from, I think, $80 to close to $120 a barrel. And that was due to the de facto closure of the Strait of Hormuz, which carries about 25% of the global seaborne oil supply. As oil prices increased, the S&P 500 fell amid concerns over the potential impact on inflation and the overall economy. And low energy prices have kept inflation in check to a certain extent. They have energy, the biggest component of inflation is labor, and then probably second or third on that list of what impacts inflation the most tends to be oil and energy prices. And the fact that it has been low has really helped the case for inflation somewhat being close to a target zone. It's been a little bit stickier, a little bit higher than most central banks would like, but it has not been out of control. And one of the reasons probably is that oil has been so low. Now, with that changing, uh, investors are quite fearful that inflation will be more than sticky, it will rise. So where does that take us now? Just to give you sort of a glimpse of the energy stocks being the top performing stocks and sector really year to date. As you can see, XLE on the far right-hand side, over the last month, it's up about 5%. It's the second best performing sector. Utilities is actually the best performing at being up 7.75% over the last week. You'll see over the last 5 days, everything is in red with the exception of energy, which is up 0.23. So the market really selling off across the board with the exception of the energy sector. The sector year to date, in fact, is up about 25%, making it the highest performing sector year to date out of all the 11 gig sectors. And energy stocks stand to gain from what is going on with this crisis right now. So a little bit about the oil price volatility.
Steve,
Iran's most vital. Yeah,
I would love to jump in here and kind of give some clarity as to what we're looking at here.
yeah,
Because
that'd
I
be awesome.
across this
Absolutely.
chart a little while ago this morning while I was doing some research for this video here today. And to provide context, right? The oil market is global. We do have to keep that in mind. And obviously, there's a lot going on in the Middle East around the Strait of Hormuz. As Steve was saying, it is a crucial choke point of the region. But we do have to remind ourselves that there are other countries that produce oil, such as Russia or Venezuela or the United States. So I went ahead and threw together some stats here so everybody can see that Iran was actually exporting about 90% of their oil to China. And if you see on this chart here, there's actually a large number of oil ships off the coast of China waiting to be brought into the refiners. So everybody wasn't really too worried about the volatility of China maybe joining the war because they have a supply right there waiting for them. Then you have to keep in mind, United States is exporting more than ever oil to the rest of the world, and also our LNG exports are tremendous. Obviously, Russia is increasing theirs as well. There's some news about sanctions being eased up during this time, and then also on top of that, the stuff that's happened in Venezuela recently, and J.P. Morgan analysts and some others that I've been reading up on have been talking about how Venezuela might increase their barrels export to the world as well. So all that to be said, there is this shift. There is a near-term focus of fear in the oil market, which is very warranted, right? But in the long term of things, there are other players that could potentially step up. And it's going to be these companies that you're probably talking about today that are investing so much CapEx growth and continue to go and drill for new oil spots and find new deposits and refine it and give it to the world. So I'm excited to see the five stocks. And it might surprise some people because I was surprised that not all of them were, US based because we do focus on US stuff a lot.
Yeah, no, definitely this has some global diversification to it. And without question, utilities are in demand from data centers. Utilities, a lot of them use oil. So tremendous fear and pressure there. But you're absolutely right, Daniel. I think we were sort of in a panic situation over the weekend when we saw it surge from 80 to 120. We could easily see a number of other places increasingly come online. We could see the U.S. Starting up some rigs that have been down for quite a while. So there are definitely ways to get more oil out. And also, it could be 2 to 3 weeks, but things, might be under control to the extent where a lot of these tankers could have escorts by the U.S. Navy and ships could be flowing across the Strait of Hormuz again.
Right.
So may not be too long at all. However, having said that, despite we put this up earlier when it was a 10% slide, it's actually more than a 10% slide, but prediction markets are not convinced that the oil rally is over. You can see below what the Kalshi traders are predicting when asked how high will WTI oil get by the end of the year. 83% believe it's going to be over $95. There's a 50% chance that it could be over $120, and some even a 16% chance that it could be over $180. So it seems like many of these traders are not convinced that it's going to come back down soon. And it tends to always happen that way. When a particular sector and asset class could be flat for a while, and then all of a sudden there's like incredible demand and short supply, that price never seems to come back down as fast as you would like. And that's
And let's be
inflation.
clear. We don't
Yeah.
want this to happen, right? The higher
No.
the oil prices go up, it leads to inflation and that will spiral into the economy. And then what is the Fed going to do? They're going to have no choice but to raise rates. And no one wants that to happen. So
Mm.
nobody should be rooting for a $150 barrel of oil.
Yeah. And again, these are prediction markets. I don't believe you have most economists saying this, but these are the Kalshi traders. And, they're saying that there's an 83% chance by the end of the year it could be above $95. We'll see how that plays out. My hope is that it does not happen. So, what is quant? Why do we use it? Quant is a combination of fundamental analysis and advanced computer processing. So what we do on the quant side is not that different than most fundamental analysts. What we look at are companies that are collectively strong on value, growth, profitability, positive EPS revisions, and momentum. And I refer to this as a growth, a GARP strategy, which is growth at a reasonable price. Many portfolio managers and many analysts use a similar style. Uh, but what the quant does is we take almost all the data that we can for all the stocks that we look at, which is a universe close to 5,000 stocks. And we're looking at every single company's balance sheet, income statement, cash flow statement, and hundreds of financial metrics across the spectrum of value and growth and profitability. And we use this data and math and algorithms to identify the GARP strategy that we like. So again, those are companies that are collectively strong on those investment characteristics that I mentioned. So the quant aspect is we use computer processing to identify and score those companies, as opposed to like an analyst who worked at Merrill Lynch or Morgan Stanley, Goldman Sachs. As a single analyst, you're only capable of covering so many companies. We cover close to 5,000 stocks on the quant side. Having been a former analyst, I can tell you really the most companies that you can cover, maybe within a sector, are about 20 companies. Your ability to write research on those companies is fairly limited. Maybe you can get like four companies written up a month that have a detailed report and a couple other shorter reports. The beauty of the quant is that we update our system every day. So we take that data and we scrape through to see if any changes occur to it, as well as the financial metrics. And by doing that, we sort the strong from the weak, and we can put a directional recommendation of strong buy, hold, sell, or strong sell on the company. And we refresh it every single day. So that is quant. It is taking fundamental analysis and the power of computer processing and marrying it together. And we have a pretty good track record. If you look over the last 5 years, these are the simulated strong buys from our quant system. So this would be all the strong buys every single day. And you can see that over a 5 year period, they're up 160% compared to Wall Street analysts' strong buys, again, refreshed every day. They're up only 7.5%. And the S&P 500 for that same period is up 56%. So quant having a very good track record over the last 5 years. Uh, Now that brings us to the top energy stocks for this oil surge. How I pick the energy stocks, we use Seeking Alpha's stock screener, which is easily accessible, very user friendly. You go to the screening section, simply just click on the energy sector. And by doing that, I assess the companies that have quant strong buys. There's a little bit of diversification in what they do. Some engage in exploration, some in production, some in development, some in shipping and storage and oil and gas. So I took a little creative license. So the list doesn't read one, two, three, four, five as if you went to the screen itself, because I like diversification. And we also have the international diversification there as well. So that's how I pick the stocks, but they're all quant strong buys. And as I mentioned, these stocks were also quant strong buys before the crisis occurred. Okay, so our first of our picks is Petrobras, ticker symbol PBR. This is Brazil's national oil company. It's a huge, huge company. It's got a market cap of 112 billion. Within the energy sector, it ranks three out of 225 stocks. And within the industry of integrated oil and gas, it ranks one out of 16. Over the last year, the stock is up 42%. So I want to bring you to the far right side where you see the factor grades. As you look at these factor grades, which are academic letter grades, you'll see it for the investment characteristics that I mentioned earlier: value, growth, profitability, momentum, and EPS revisions. And these factor grades are all sector relative. So when you look at that valuation grade of A, you know that Petrobras is very, very attractive on a valuation framework compared to the sector. Now, what I'll also mention is despite the stock being up 42% in the last year, the valuation framework is still just as attractive. 6 months ago, it was an A, currently is an A. So that means as the company has been growing its earnings, the value still looks attractive. You can see the growth grade is more or less the same. It's a C now. It was a C plus 6 months ago. Extremely profitable compared to most other energy companies with an A plus grade. Momentum has definitely increased to A minus from D plus just 3 months ago and a C minus 6 months ago. So investors really liking this company right now, hence the momentum and the momentum compared to the rest of the sector. So keeping in mind that's a sector relative grade there, that means that this stock has been beating the rest of the energy sector. And the revisions grade, you can see analysts also like it. These are EPS revisions, and this is actually the quantity of analysts that are taking their estimates up. So many analysts are positive on the company now, as you can see with that A grade versus the sector, but also compared to where it was just 6 months ago, it had a C grade. So analysts over the last 6 months have increasingly become positive on the company. Um, as I mentioned, this is a Brazilian company, it is a giant, and they are engaged. They're sort of full services. They're engaged in exploration, production, refining, and the transport of energy products. Their long-term EPS growth rate for the 3 to 5 years out is 24% versus the rest of the sector at just 8%. And the return on equity is huge at 28% versus 10% for the rest of the sector. Uh, Although you see the valuation grade is a A, which means on many metrics it's attractive. One of the more attractive valuation metrics is PEG, which is a combination of PE and growth combined, and it puts it at a 78% discount to the energy sector. So very, very attractive. Our number two stock is INI, which is an Italian oil giant. This company is not as big as Petrobras, but still it's big. It's got a market cap of 71 billion. In the energy sector, it ranks 19 out of 225. Within the integrated oil and gas, it ranks 2 out of 16. But the stock has done amazingly well over the last year. It is up 63%. Um, and despite that 63% move, if you look at the valuation on the far right, you'll actually see the value is more attractive now than the company was 6 months ago versus the sector. And you'll also see the growth is an A minus now versus a D 6 months ago. So the stock is up 63%. Growth is even stronger than it was, and the value is the valuation framework is even more attractive. So we really like ENI here. Their long-term EPS growth rate is 42% versus the sector at 8%. And their ROE growth is 3%. So this isn't the absolute ROE, which I mentioned earlier. This is actually the ROE growth rate. And at 3%, it's very attractive compared to the sector because the sector's ROE growth rate is negative 3%. On a PEG basis, it's a 74% discount to the sector. Stock number three is Frontline PLC, ticker symbol FRO. This is significantly smaller than the other companies. Its market cap is about 7.9 billion. Within the energy sector, though, it ranks very high at 6 out of 225. This company is focused on oil and gas storage and transportation, and it ranks 2 out of 54 stocks within this segment. The 1 year return is up a whopping 134%. But despite that meteoric rise in the stock, you can see the valuation is almost exactly the same as it was 6 months ago. So still attractive. It's in line with the rest of the sector, but it certainly is not expensive. But we can see, which is really nice, is the growth rate is A minus versus 6 months ago at B minus. So the growth has improved significantly for the company. The valuation has stayed the same, very profitable with an A minus grade. Momentum very strong versus the sector. Analysts increasingly like this company. As you can see, the current grade is A plus, which means a lot of analysts have been taking their estimates up relative to the rest of the sector, but even more so compared to 6 months ago when it had a grade of a D. Stock number four, DHT Holdings. This has a market cap of 3 billion. Within the energy sector, it is currently 8 out of 225. And with oil and gas and storage and transportation, it is 4 out of 54. Again, 1 year return on this stock is up 82%, but very attractive valuation. You can see the grade is actually B versus the sector. And when you're looking to buy a company, you really, the price increase of a stock. It could be 10%, 100%, 1,000%. What you're basing your purchase on is how the value looks compared to the sector, and maybe it's historical average and the growth rate versus the sector. And you can see for this company, even with that 82% rise, the value is very attractive with that B grade, and the growth at A minus. And I'm actually going to go to our platform, Daniel, to show everyone the stock, what it looks like. So we're going to put in DHT on the platform.
EXP from Bermuda.
Okay, so you can see the stock has had a really nice rise since December, and it's got that quant strong buy. And we're going to click on valuation, and you can see the overall value grade is B. And if you look at the forward PE, it's actually super cheap. Its multiple is 9.75 times versus the sector at 15 times. So it's a 37% discount to the sector. And then we look at on a PEG basis. Um, PEG here is actually a little bit of a premium to the group. That's the trailing PEG, the forward PEG, which, sorry, it'd be nice if we had that. I think that would be a much more attractive metric there if we had the PEG, and I'm not sure why the non-GAAP PEG isn't there. You can see in some areas it is expensive on EV to sales, but EV to EBIT on a forward basis, A minus, very, very attractive. Um, and then if you look at the dividend yield, that's also very attractive versus the sector too, at 5% versus the sector at 3%. So the overall valuation grade is a B, despite the stock doing so well over the course of the year. And the growth on the company, A minus overall. You can see the forward revenue growth is at 5%, but what looks really attractive is if you look at the EPS year over year is 16% versus negative 4% for the sector. EPS on a GAAP basis, very similar at almost 17% versus negative 5.6%. And then on a forward EPS basis, 7.25% growth versus the sector at 5.25. So from a valuation standpoint, it's very attractive. And from a growth perspective, it's attractive versus the group as well. Going to take us back to the slideshow and
Also going to
enlarge it for
mention
those who are on the phone.
the dividend yield forward is actually sitting at 8.65% for that company as well. That's a nice kicker.
That is a nice kicker. So if we go to the stock page, you can see it right over here. The yield is 8.65%. If we scroll down, you can see the dividend safety grade is B minus. 6 months ago, it was actually D, so it's much more attractive now in terms of the dividend safety and dividend growth compared to the sector. And the yield, as Daniel mentioned, is very high, so that dividend yield grade is Y. The dividend yield grade is A. All right, back to our slideshow. And a couple of the other points that are really interesting, 60% EBITDA margin versus the sector at 33%. Daniel mentioned the yield, and I mentioned the PE versus the sector as well. Our next stock and final one is Transocean Rig. Transocean, ticker symbol RIG, Rig. Market cap is $6 billion. This ranks 16 out of 225 in the sector. And within oil and gas drilling, it is 2 out of 9. Again, a whopping return for the year. It is up over 108%. The valuation is definitely a little bit more pricey than it was 6 months ago, but at C plus, that puts it in line with the sector, and the growth is a B plus. So this ranks number 5. The others are, quite attractive, but this company still attractive, still a quant strong buy. 68% operating cash flow year over year versus the sector at only 3%, and it has a 27% leverage free cash flow margin versus the sector at 4%. On a price to book basis, it's a 57% discount to the sector. So that is it for our 5 stocks. Here's sort of a picture to show you all 5 and their grades, and you can see where they stand on growth, where they stand on value, where they stand on profitability. Again, these are my top energy stock picks, which showcase very strong fundamentals and have had great momentum. And this all occurred before the energy crisis. My thought is going into this energy crisis, they'll continue to do even better.
Steve, I should mention as
So
well, quick, since we've started recording this video today, going into these stocks, and obviously everybody watching, we hope family, friends, communities, we really stand with you. I mean, I hope everybody is staying as safe as possible. But within this time, we're in this moment of oil volatility where since we started talking to where we are right now in this recording, oil's back up 10%. You're seeing headlines break left and right about, possible ships being transported through by the US military from high-ranking officials that are later deleted and announced right now on headline news. And then you have other reports coming out about Iranian people laying mines in the Strait of Hormuz. So I think all investors stay prudent. Think about these stocks that Steve presented today. I mean, as we mentioned, this is Brazil, Italy, Cyprus, Bermuda, Switzerland. This is where these companies originate from, but they're working on a global production basis. And hopefully they can step up to this opportunity and produce their results.
yeah, Daniel, look at this volatility for crude oil futures just over the last 5 days. Um, it's up about 9% now, but you could see if you went back, it was at around $77 just 5 days ago, and then surging up to I think it was like at 120 at one point.
Yeah.
The
Yeah.
pulling that up right here, and then coming right back down to its current level of $84.54. Still relatively high, but it is just incredible volatility that we're seeing there.
Yeah. Yeah. So, Steve, I was actually hoping as we go into the wrap up here, obviously, there's the five stocks. Would you mind taking a moment just to show people where to find the energy screener here on Seeking Alpha
Yeah,
that
absolutely.
quantitative?
So, really quite easy to find it. Very user-friendly platform. If you look on the left-hand menu, you can simply slide down, and if you go all the way to the bottom, you will see Stock Screener. And we're just going to click on Stock Screener. And we have a number of pre-baked screens that we've created for people. So you can look at the top quant dividend stocks, all stocks, top-rated stocks, stocks by quant, trending AI stocks, semiconductor stocks, top growth, top dividend, top small cap, top value China ADRs, top technology, top healthcare, top financial. And as we scroll down, you will see top energy stocks right there. All you have to do, again, once again, left-hand side, go to stock screener, scroll down once it comes up and click on top energy stocks. And you can actually choose those stocks yourself. So the list I provided today, as I mentioned, I had a couple parameters and criteria that I was including, as well as diversification. So that's why you're not seeing that straight rundown from 1 to 10, but definitely a very good list that we've put together here.
Yeah.
And bring us back to the slideshow,
I
Daniel.
want to say for the people that don't want to do the research themselves and use the screeners and everything else, why don't you walk us through real quick the two products you created actually that have been helping investors for the last couple of years now?
Yeah, yeah. I mean, the webinars we do are on occasion or on random. We do maybe one or two a month. I write articles all the time, so if you see the articles, please follow me. But to get a consistent flow of ideas, I created two products for it because many people wanted it. So one product is called the Pro Quant Portfolio, and the other product is Alpha Picks, which is a little bit longer in terms of its existence. That's going to be coming up on 3.5 years now, Alpha Picks. And as you could see, just over the last year, the return on Alpha Picks is up 68.9% versus the S&P at 17.78%. So what is Alpha Picks? We try to make it easy for you. Every month, I send you my two favorite quant strong buys on the trading date that's closest to the first of the month and the 15th. We send it by email. We also have a platform that you can go to retrieve it. Every time there's a stock that we recommend, we write an article on it. We're very transparent. We put those articles on the platform. So you can literally go back to the first article in July of 2022, and that is still there. Very transparent in our platform that we show you the price that it's recommended, the weight, the quant rating on it. So we try to be as transparent as possible. And it is a fairly conservative in that we're only providing you with two ideas a month. We look at companies that have a market cap over 500 million. We pretty much only invest in US stocks or ADRs that are primarily listed in the US. Stocks have to be over $10 a share. So as you can see, the product has had really good performance, but something that I ran into consistently is people wanted more than just two ideas a month. So we created the Pro Quant portfolio. And this is a portfolio of 30 stocks, but we rebalance it weekly. So it's always going to be 30 stocks where alpha picks can continue to grow and grow as we add on two new names every month. The Pro Quant portfolio gets rebalanced every Monday. And the big difference is on a weekly basis, we typically have 2 to 3 new ideas every week. So two ideas come in, two ideas go out of the portfolio. That started in June of 2025, and that's had very good performance as well. You can see the Pro Quant portfolio is up 32.59% versus the S&P on an equal weighted basis of 12.7% for the same period. So very strong performance out of both. Common thread with both is that they're quant strong buys. Big difference. One is two ideas a month, and the other is rebalanced weekly, which provides you 2 to 3 new ideas every month. And Dale, I think that's it. See if there are any questions.
Yeah, I just want to mention as well about Alpha Pix and Pro Quant portfolio. I mean, obviously, Alpha Pix has done tremendously well. I think if I remember right, we launched in July of 2022. Since
Yep.
inception, it's up 286.5% compared to the S&P 500, which is up 79.7%. And then obviously, Pro Quant portfolio, as you mentioned, was launched last June and is beating the equal weight index. As you see there, 32.59% compared to the equal weight at 12.71. So well done, Steve and company. I
Thank you.
also want to mention as well the community there that you have built in both of these products is tremendous. And you do get the two stock ideas every month from Alpha Picks. And then on average, it's a couple of stocks that are bought and sold on ProQuant portfolio. Some weeks you do have those weeks where nothing changes in the portfolio, and that's all based on the quant system, a systematic approach. So highly encourage everybody to check it out. Click the links beneath this video, and you can find out more information there. Now, Steve, one question for you about the 5 stocks we presented here today, because a
Yep.
lot of these webinars we focus on stocks and the US stock market, which obviously these are listed here, but they're international. Is there any
Yes.
worry about how that might affect the American US stock market investors when they buy stocks in these companies?
Well, sometimes they pay dividends, and many of these do. When you do get these dividends, they're taxed a little bit differently for the dividend payouts, but very easy. Your brokerage firm usually sends you something for that tax. You'll receive a credit for it. So if you're on something like TurboTax, it actually happens automatically when you pull in your tax forms from your broker. So from a tax perspective, there is a different type of tax on it, but you do usually receive a credit. I would say the diversification is very positive in this environment. Um, the US market is very, very volatile now. Uh, Most markets are pretty volatile right now, but really what we wanted to do is provide some diversification within the industries of these companies and geographic. And usually diversification helps to minimize risk and maximize returns. So that's what we're looking to do with these recommendations. And again, the beauty of this is all these companies have really strong financials. They were all quant strong buys before this crisis started to occur with Iran. And we think that they will continue to benefit on the back of it.
All right. And now everybody obviously go talk to a tax advisor if you have questions about the dividends as well, because Steve and I are not tax advisors. But Steve, another question for you, because you've been in the industry so long, as we mentioned before. I mean, oil shocks have happened before throughout the decades. Does this time rhyme in history to any other time to you? Is there anything that comes to mind, or does this come as a brand new scenario that investors need to keep an eye on?
This is definitely not brand new. I wish I had this table up in front of me, but I was looking back at every sort of military action since 1950, and it felt like overwhelmingly the majority of the military actions that occurred had to do with the Middle East. So this is definitely not something that's new. And we've learned by history that if you actually purchase stocks during the initial corrective phase, you actually pan out to do very, very well. So I would say to any investor, as people are panicking, as they did with the energy markets on over the weekend when spot went to $120 and then massively pulled back, use other people's panic as your opportunity. Stay calm. Add to positions with great fundamentals. If you believe this crisis could occur for a while, I use what's called a barbell approach. On one side of the portfolio, I invest in stocks that have good dividend yields, but great balance sheets. And then on the other side of the portfolio, I'm actually looking for stocks that are coming off sharply that have good fundamentals. So during periods like this, fear will drive sentiment, which will always drive stocks down, and it will drive investors out of good companies into safe haven arenas. And when that happens, good companies' stock prices fall sharply, and you want to use that to your advantage. So as these prices fall, you should be picking up stocks with good fundamentals. But as I said, you could have that barbell approach and also invest in companies with a good balance sheet and a good dividend yield as well, which will sort of mute some of the downside during this period. And that's really it, Daniel. That's the guidance that I would provide.
Spoken like a true veteran, sir. Thank you very much for your time today. Everyone, thank you so much for taking the time to check out this video. Hopefully, you can put these 5 stocks at least in a Seeking Alpha portfolio and keep an eye on them like I like to do as well here. But everyone, stay safe. Everybody keep an eye on these headlines, and we're here with you. We'll see you here in the next webinar real soon. Take care.
Thank you.